So this is problem 14.2. I'm not going to print or write out the whole problem, so I'm going to let you look at that either in the book or you can print out the notes that go with this. We will work through all the ratios though. So earnings per share is the first one, and that's going to be your net income divided or minus your preferred dividends. Divided by your weighted average common shares outstanding. So you have to know a lot of vocab just to do that. Outstanding, they haven't been bought back. They're the ones that have been issued in outstanding. Common, not preferred shares. Weighted average, mercifully, you were just given this number. If you go on in accounting, you'll have to compute it. In this problem, where we start with net income minus preferred dividends, we check to see, well, are there any preferred dividends? Well, there's no preferred stock. We look at stockholders' equity section of the balance sheet, and there's only common stock. We go to the most recent income statement, and we see that net income is 203. We know that there's no preferred dividends. And then the weighted average common shares outstanding, they give us at 57,000. We divide that out and we get our earnings per share of $3.56. So this is our earnings per share. Okay, so that's your earnings per share. The next thing they ask us to do is the return on common stockholders' equity. Okay, so with this, we're also starting with our net income minus the preferred dividends. However, we're going to be dividing by the average common stockholders' equity. Okay, so we've got net income minus preferred dividends. That's the 203 minus 0. That part's done. Average stockholders' equity. When they ask for an average, what you're going to be doing is taking the beginning balance plus the ending balance and divide by 2. So we have total stockholders' equity for 2014 of 465.4, and then we've got 566,700 for 2015. We would add those two together. We get the 103,100, divide by 2, and that would give us the 516,050. So beginning balance plus ending balance divided by 2. The only thing that could trick you up here would be if there were preferred stock. That would have to be excluded because it's common stockholders' equity. All right? And I don't think any of the problems do that. So when you do this out, you would get 0.39 or 39% as your solution here. Okay, the next thing they ask us to do is return on assets. Okay, so here with the return on assets, it's just our net income, but it's going to be divided by our average total assets. Okay, net income divided by average total assets. All right, so we got the 203, we know that. Average total assets, we go up to the balance sheet, and we've got the 970,200 and the 852.8. Add them together, divide by 2, and we get average total assets of 911,500. And when we do that out, it's 22%. Okay, you express it either way, 22% or 0.22. So that's your return on assets. Then the next thing they ask us is the current ratio. All right, so current ratio, that's going to be equal to current assets divided by your current liabilities. Okay, So you have to go, and this problem gives us both. We go to the balance sheet, total current assets, 369.9. Total current liabilities, if we go down a little bit, we see the total current liabilities, 2035. And you divide them out, and you get 1.82. And this is usually expressed 1.82 to 1. In other words, for every dollar of liabilities, they've got $1.82 of assets to cover it. One little caveat on this one. You could have two companies, okay? So you've got company A, and they've got current assets. And let's say that it's made up of cash and accounts receivable and inventory. I'm just simplifying. This is not from the problem. But say you had, you could have cash of 100,000. You could have accounts receivable of 50,000. And you could have inventory of 50,000. Let's make this 200,000. Okay, so then you come up with 300,000. So that would be your current assets. But company B could have the same current ratio. I'm just leaving off the 69.9 here. I'm just rounding to 300 because of my math skills. Okay, you could have company B who had say 200,000 in inventory, and had had the 50 had let's say 200. They had 10,000 in cash and 90,000 in accounts receivable, and they would have 300,000 as total current assets. These two companies would have the same current ratio, but who has the better ability to pay the bills? This B only has 10,000 in cash. They've got inventory that may never sell. They've got receivables that might not be collected. So, but the main thing is they've got no cash, or very little cash. So this is a starting point. You do the current ratio, but then you kind of look at it a little further. One thing that refines the current ratio is the acid test ratio. And this is where you take your more liquid current assets, your cash, your short-term investments, and your accounts receivable net. So that's your accounts receivable less your allowance for doubtful accounts, and divide by your current liabilities. This gives you a little better indication of how much you could come up with if you had to pay your bills today or this week. So here you would have 60,100 in cash, plus you would have your 69,000 short-term investments, which presumably can be sold, and the 107.8 of accounts receivable, divided by the same current liabilities of 203,500. And so you can see this comes out to 1.16 to 1. In other words, here, if you had to come up with the cash immediately, you have $1.16 for every dollar of liabilities that you owe. Okay, so that's the acid test ratio. Let's go to some of the turnover ratios. The first one that we come to is your accounts receivable turnover. So accounts receivable turnover. How often, on average, are we collecting our receivables? And this is going to be your net credit sales divided by your average, okay, you start thinking beginning and end, add them up, divide by 2, average net accounts receivable. Okay, so this needs a little translation. This is why having the formulas doesn't help you unless you've done some of these out. Because first of all, net credit sales, that's going to be your sales less your sales returns and allowances, and less your sales discounts. So you need to know that the formula wants net credit sales and not cash sales. okay? They want just sales that were made on credit. So net credit sales, average net accounts receivable. Accounts receivable less your allowance for doubtful accounts gives you your net accounts receivable, which is pretty much given in the problem. Okay, so your net credit sales, and you want to go to the income statement, most recent year, is 1,818,500. Make sure you don't mix up and use net income when they're asking for net credit sales. Average accounts receivable, we go to the balance sheet, we get our beginning, our ending, we add them up and divide by 2, and so our average comes out to 1,053. And so on average, we are collecting our receivables 17.27 times each period. Okay? All right, so you can change this one, any of the turnover ratio. If you do 365 divided by the turnover ratio, that gives you sort of on average how many days it takes. It's sort of the collection period in days. And that helps to understand why a higher turnover ratio might be better than a lower one. So say you had 365 and your turnover ratio and it came in at 10, on average you would be collecting your receivables every 36.5 days. Okay, if it were, yeah, so that's your collection period in days. All right. So the next one they do is inventory turnover. So let's look at inventory turnover. And inventory turnover, you're going to do your cost of goods sold divided by your average inventory. Go to the most recent year, we get our cost of goods sold, which is 1,011,500. Average inventory, we go beginning plus ending divided by 2, 124,250. And so on average, our inventory is turning over, oops, I'm sorry, that comes out to 8.14, I think, 8.14 times. So when you start looking at these, it's you want to start saying, well, gee, is it better to have a lower one of these or a higher one? Is 10 better, or would 20 be better? Would 5 be better? And so one way to have that make more sense to you is you can also do the days in inventory, which you take 365 and you divide it by your inventory turnover to see how many days on average you're holding your inventory. So 365, if your inventory turnover were 10, you'd be holding it on average 36.5 days. So by messing with this, you can say, okay, so if it were 20, would that be better? If it were 5, would that be better? You know, use numbers that you don't have to divide them all out. Okay, so that's your days, your inventory turnover in days in inventory. The next one we get to is times interest earned. Okay, and this is going to be net income plus your interest expense. Make sure you don't pick up interest revenue. Plus your income tax expense. And you're going to divide that whole thing by your interest expense. Okay, so here you just go to the income statement, the most recent one. Your net income is the 203, we've gotten that before. Interest expense, 18. And your income tax expense, 87. Divide that all out by interest expense, and you get 17.11 times. And this is really telling the company's ability to pay its interest, presumably on its long-term obligations. It's more of a solvency measure here to say, well, gee, you know, how many times could they pay that interest? Just gives a measure of that. Okay, so asset turnover. Let's look at asset turnover. This is net sales. Okay, and remember we're using net sales divided by average total assets. So not current, not long-term, but total assets. We go up to the top, net sales, that's at 1,818,500, divided by your average total assets. So you take your beginning total assets, ending total assets, 911,500, and you get 2.0 times for your asset turnover ratio. Okay, then you come down to debt to total assets. So this is fairly straightforward. You go to your total debt, that's your total liabilities. Okay, debt, another word for liabilities, divided by your total assets. Okay, so if we're looking at this total debt, you would go to the balance sheet and it would be your total liabilities of 4,035 divided by your total assets, which it gives you as 970,200, and you get a ratio of 0.42. This is a pretty important ratio to understand how it works. If you had a company that had total debt of 100,000 and total assets of 200,000, probably not too bad. They would come out with their 0.5. But what if you had a company that had total debt of 200 and total assets of 100? Okay, that would not be so good. This is an instance where a higher number is not a good thing. Okay, so debt to total assets. That works through most of the different ratios, and if there are particular ones that you run into doing the homework that you don't understand, email me on that and I'll do more of these. But I think this gives you the general idea of how to calculate most of them, like what to do when you see average total something. Okay, that's it.